Welcome to RBC's Markets in Motion podcast, recorded January 31st, 2022. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. This week in the podcast, we run through 5 good things we're seeing in the data right now for the broader U.S. equity market. First, bottom-up 2022 and 2023 earnings forecasts have been holding steady. Second, the contraction in the S&P 500 forward PE is in line with past Fed tightenings. Third, the valuation gap between the most and least expensive stocks is getting close to pre-pandemic levels. Fourth, retail investor sentiment is back to pandemic lows. Fifth and finally, small cap futures positioning is on the cusp of net short territory and isn't too far above where it bottomed in March 2020. If you'd like to hear more, here's another 5 minutes. While you're waiting, a quick reminder that you can subscribe to this podcast on all major third-party providers. Now the details. First, bottom-up 2022 and 2023 earnings forecasts have actually been holding steady. With roughly a third of S&P results in, the full-year bottom-up forecast for S&P 500 EPS is still tracking at $2.24 for 2022, identical to mid-January's reading, while 2023 is tracking at $2.47, up $1 from mid-January's reading. The rate of upward revisions is also still tracking at 58%. In other words, slightly more positive than negative revisions. Interestingly, while 52% of S&P companies that have reported so far have seen their share prices fall 1% or more in the one-day trading session immediately post-results, that stat is actually a little bit better than it was a week ago when it was tracking at 63%. It's been helped by tech. Overall, there's been a resiliency to earnings forecasts despite the volatility in the market. Second, the contraction in the S&P 500 forward PE is in line with past Fed tightenings. We've seen contraction in the broader market's forward PE multiple of about 16% since the end of 2021. That's important because our analysis suggests that from the high around liftoff to the trough in the hiking cycle, the market's forward PE has experienced an average drop of 16% and a median drop of 17%. Looking back to the 90s, the worst was 21, the shallowest 7, and the last 2 came in around 17. Obviously, the multiple contraction today could overshoot the average, and our analysis suggests that if a 21% contraction occurred with no changes to earnings expectations, the index could fall to 4150. But this still tells us a lot of the damage from the repricing of the Fed alone has already been done. Third, the valuation gap between the most expensive and least expensive stocks is getting close to pre-pandemic levels. The ratio of the PE multiple of the most expensive stocks relative to the PE multiple of the cheapest stocks is now only 8% above pre-pandemic levels. As a reminder, the most expensive names are mostly tech and secular growth, and the cheapest are mostly cyclicals, including financials and commodities. This is important because to the extent that part of the year-to-date rotation is about pulling out the pandemic-related froth from growth stocks, a lot of that work has already been done as well. Fourth, retail investor sentiment is back to pandemic lows. A week ago, we flagged that net bullishness on the AAII survey had gotten very close to pandemic lows, which also tends to be the low end of the historical range. In the latest update, this indicator officially got there. Net bulls fell to minus 29.8%, right in line with 2020's low of minus 29%. On a 4-week average, this indicator is now at minus 17.4. This is important because below the minus 10% threshold on the 4-week average, the S&P 500 has been up 15% on average over the next 12 months, 86% of the time. A 15% rally off Thursday's low would take the S&P 500 back to 49.75, not too far below our own year-end S&P target of 50.50. Fifth and finally, small cap futures positioning is on the cusp of net short territory and not too far above where it bottomed in March of 2020. Small caps are often treated as pure plays on macro hopes and fears, and their rough start to the year has been one of the things that unsettled us the most as 2022 got underway. In last week's CFTC update, reported late Friday, reflecting Tuesday pricing, small cap positioning declined for the 3rd week in a row and came very, very close to net short territory. Though this indicator isn't back down to historical lows yet, which were achieved in the financial crisis and the earnings recession of 2015-2016, this indicator is very close to March 2020 lows, when it entered net short territory for a very brief period of time before rebounding. Tying it all together, To those wondering if we think we need to cut our year-end target on the S&P 500, our answer is no, not right now. If economic forecasts and earnings hold up, sentiment is likely at its low point. Pandemic valuation premiums seem mostly out, the Fed seems mostly priced in, and small caps are very close to looking oversold. We also think it's important to listen to what the market is trying to tell us here. So far, the S&P 500 drawdown hasn't cracked 10% on the close, which is telling us that the market hasn't been ready to price in a growth scare just yet. Clearly, that could change, and if it does, the stat to remember is that when those have happened in the post-financial crisis era, the growth scare drawdowns have tended to be in the -15 to -20% range. Actual recessions tend to see the S&P 500 fall more sharply, around 33% on average. That's all for now. Thanks for listening, and be sure to check out our sister podcast, RBC's Industry in Motion, for thoughts on specific sectors from RBC's team of equity analysts.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.